Hi, so this is for everyone out there who is new to the investing world, and I'm going to assume that you've decided that the stock market is the best place for you to invest your money. But if you haven't invested in the stock market before, well, where do you even start? There is just so much noise out there about stock market investing, and it's just really difficult to find a single starting point. And probably like so many people out there, you're a little bit scared of losing money because without experience, well, you just think that you're throwing money away without really understanding what's happening. So today I'm going to show you exactly how to get started all the way up to buying your first shares. Now, don't just skip through this video to see how to actually just buy shares, because I'm going to cover off the basics that you need to know and a few different strategies that you could follow. And I'm going to let you in on a little secret. You have a really big advantage over professional investors and the hedge funds. If you are new to my channel, well, welcome. My videos are about investments that anyone in the world can make. Now, I think the stock market is the best opportunity for good long-term returns. I think there's far less work involved in, say, real estate investing or starting your own business. But unfortunately, 90% of all stock market investors lose money. Now, that's a horrible statistic. And I think with a better plan, we can be on the right side of that statistic. Now, this is really important. Being a stock market investor starts well before you buy your first shares. Don't worry, in this video, I will show you exactly how to buy shares, but there's a lot of work we have to do before we get to that point. So even if you haven't started investing before and you're really just a beginner in this journey, well, you have to try to think about what type of investor you're going to be. And the first thing you have to ask yourself is, when do I need the money that I'm going to invest? So ask yourself these things. Are you saving up for a house and might buy this in, say, the next year or two? Are you looking to make enough money to quit your job as soon as possible and become a full-time investor? Do you have extra money that you're okay with keeping invested for at least 5 years? If you answered yes to these first two questions, well, I actually don't think the stock market is for you. It will just chew you up and spit you out. And I have no doubt you will become one of those 90% of failed investors. But if you answered no for the first two questions, but yes for the third question, we can move on. Do you like the idea of reading financial reports and listening to CEOs speak about their companies? Well, if you do, well, you're probably going to be quite a good active investor. An active investor is somebody who puts a lot of research in to try to pick the best investments to get the highest return possible. But if balance sheets and annual reports seem boring to you, well, that's okay too. And in this case, you'll be a better passive investor. And a passive investor is somebody who sticks to a very structured plan and does it without thinking. Doing this takes actually very little time each year, and you'll get very solid results as well. Now, let me address just one of the questions that I get all of the time. But isn't it a bad time to invest right now? Maybe I'll just wait for the bottom. Now, I'll make another video on this topic again one day, but all I really need to say right now is please don't get distracted by things like momentum investing or technical investing. If someone says they can read a price chart and it is showing signs of a candlestick, head and shoulders, double dip buy pattern, please just run away. All of this stuff is just pseudoscience and none of it is backed up with any empirical evidence. Now, if you are going to be a passive investor, your plan is going to be to just invest consistently, maybe every month or every 3 months. And that's it. And because you're investing consistently, you're going to be investing sometimes when the market is high and sometimes when the market is low. And you'll never have to worry about trying to time the market because you've taken the emotion out of it, and that's the key. There are some pretty amazing investors out there, and fortunately enough, we live in a time where we can get access to all of the buys and sells of these great investors. So these guys have all proven to be ultra successful active investors. So don't be ashamed to follow their advice and copy what they do. Buy what they buy, sell what they sell. Take the emotion and all of the hard work out of it and just copy the best in the business. This is such a good strategy and I highly recommend it. So how do we exactly copy them? Well, fortunately, every quarter that the funds that these great investors are managing, well, they have to release a document called a 13F. So literally just Google 13F and for the fund that you're looking for. So I'm going to type in 13F Berkshire Hathaway, and I'm going to go to the Fintel website. Now here we're going to have a list of all the 13Fs that Berkshire Hathaway have filed, and we're going to go to the most recent one. And this is the 13F document. And in here, we can see everything that Berkshire Hathaway has, and it's actually ranked in terms of their largest position down to their smallest position. So it starts with Apple and Bank of America and Coca-Cola and so on. And while we're here, let me quickly explain how to read this 13F document. Here in the middle of the table, you can see a change percentage. So in the last quarter, this is what has happened. So this is the change as a percentage. So Wells Fargo, for example, well, they have sold 26% of the Wells Fargo position that they had. So if you had Wells Fargo, well, you could then reduce your position in Wells Fargo as well. Now, don't just go out and buy Apple and Bank of America and Coca-Cola shares at whatever today's price is, because that's not when Berkshire Hathaway bought their shares. For example, they've been accumulating Apple shares like 2 or 3 years ago, and they've been doing it for quite a period of time before that. So they had bought in at such better prices than we are seeing today. So what I'd recommend doing is just scrolling down until you find a company that Berkshire Hathaway have invested in the previous quarter, and then add to that for yourself. So I've scrolled down a little bit and I found the first buy here was Kroger Co. So they've invested about 15% extra into Kroger. So somewhere in the previous 3 months, they've bought into this company. So it's probably not a bad idea for you to buy in as well. Now, remember, if you're wanting to take the emotion out of this and just follow what the best do, that's how you do it. I get it. You're still a little nervous about losing money. Now, that's okay. So what we're going to do is a simple exercise to get you feeling a little bit more comfortable with investing, and it's called paper trading. Now, before you use your own money in the real world, just write a list of companies that you have researched and you'd be ready to buy. So here's my little example of the exercise of paper trading. So I've got the companies that I'm interested in buying, the price that I would buy them at, how much money I would spend, how many shares that I got, and the date that I made this purchase, theoretically. I really hope you're liking this video so far, and if you are, please make sure to hit that like button for me and subscribe to my channel so you don't miss out on any future videos. Now, with your paper trade document, what I want you to do is check the prices every day to see what would happen with your imaginary portfolio. What we're trying to do here is when your imaginary portfolio goes down in value, we want to know what that feels like. Because even though it is imaginary, you would have lost money if you had done exactly what you wanted to do. Now, how does that make you feel? See, the feeling of buying something and watching it go down immediately after you bought it is what every great investor has to deal with. And for me personally, I swear it happens pretty much every time I buy something. Now, understanding this feeling is one of the big secrets to investing. And those of us who can conquer this emotion will be great investors, and it's as simple as that. If it is a great company, well, you don't need to do anything, even if the price drops 30%. You'll definitely doubt that it is a great company, and you'll feel like you've missed something, but it's not. It's a great company, so just relax. Wow, I've definitely been here before, and what I do is I go back and I redo my research, and I check the thesis again, but what's happening is that the market is overreacting and nothing really has changed. A great example of this is my oil tanker investments. See, I'm very confident on the thesis. The balance sheets of all the companies that I've invested in are really strong. They've had a great year so far, yet the share prices has just been punished. And when I bought the oil tanker companies, I knew the short term was going to be volatile because spot rates were going to fluctuate quite a lot. And I knew that they probably were going to go down in that short term. But the medium term thesis is still exactly the same. So is there a problem? Well, no, not at all. I just need some time to let the thesis play out. And like pretty much all of my investments, I need to just be patient and just let the company do its thing. So here are some of my favorite terms. And if you're going to be an active investor, you're going to need to know these. Actually, you're going to need to know a lot more than just these, but here is a good place to start. All right, so we'll start with assets. And these are things that the company owns that are valuable. For example, the cash that they have in the bank, real estate, tractors, inventory, stuff like that. Liabilities. This is things that the company owes and things that haven't been paid for yet. Debt. Now, this is the most important item of all of these liabilities. This is the money that the company is owing to outsiders. Equity. Now, this is the assets minus all of the liabilities. And this is what is left over for owners if the company was to shut down today. The debt to equity ratio. And this is how much debt the company has divided by the equity number. So a number above 1 is actually not a good sign. It means the business has more debt than the value of the business itself. So I want to see this number under generally a 0.7. Debt is really important to understand. The more debt that the company has, well, the more stress that they're going to be under to make these payments. Now, just like missing a payment on your mortgage, well, if a company misses a payment on their debt, well, the bank can come in and potentially take it over. Peter Lynch famously said this: "It is very hard for a business to go bankrupt if they don't have any debt. Some of them have tried, but it's almost impossible to do." Companies go bankrupt because of debt. The balance sheet. Now, this is probably the most important of all the financial documents, and it's the document where you find the assets, the liabilities, the debt, and the equity. Now we have revenue, and this is how much money flows into the business from selling stuff or charging clients, things like that. It's essentially the business collecting money. Then we have expenses, which is the opposite of revenue, and this is how much money flows out of the business, like paying for staff or advertising and things like that. And when we do revenue minus expenses, we get what's called the net profit. And this is what the company made for the year. The bigger, the better. The company can then use this money to grow more, pay down debt, and lots of things to add value to the company. Profit and earnings are the same thing, so don't get those too confused. Sometimes people will just say earnings. The profit and loss statement. Now, this is the document where the revenue, expenses, and the profit is all reported. Now we're going to look at some really basic ratios that give us a bit of an insight into the valuation of the company, or maybe even just the performance of the company. And the first one we're going to look at is the PE ratio. And this is a very common metric for looking for value. It's one of the most quoted metrics. It is the current share price divided by the earnings per share. Now, the lower this number means better value, and the higher means worse value. Historically, the S&P 500 is somewhere between a 15 to 22 PE ratio. I don't really like this metric because it's not factoring in the debt or the cash. A company could have a low PE ratio but have huge amounts of debt, and we don't really want that. A better metric is the acquirer's multiple, which I've explained in detail in a previous video. So go check that out to understand one of the best metrics for finding value. Next up, we're going to look at the price to book value, and this is the share price divided by the book value per share. And the book value per share is just the equity of the business divided by the amount of shares the company has. So look, don't worry about any of that. Essentially, the number under 1 means you're buying shares in the company at less than the value of the business. So in theory, if the business was to completely shut down, like right now, it'd sell off everything, you'd pay off all of its debt. Well, this book value per share is what each shareholder would get. So when the price is less than this book value per share, say less than a 1, well, it's just a sign of a bargain. Now, lastly, we have earnings per share, or EPS. And this is how much earnings the company makes in relation to all the shares that the company has. So for example, if you have 5 shares of the company, and then the company made, say, 40 cents earnings per share, then you essentially have made $2. But unfortunately, you don't get to keep that $2. The company uses the $2 to grow the business further. But the business then hopefully becomes more valuable, and that's good for the share price in the long run. Generally, we want to see a growing earnings per share, but even a stable earnings per share number is fine. Now, there are so many more terms out there, but I think these are the most important ones for now. Now, please do a little bit more research on each of these terms so you really do understand what is happening. But you definitely don't have to learn all of these immediately. See, with a bit more practice and just getting familiar with these terms, soon you'll get the hang of all of them. So I've actually reviewed some of the more popular trading platforms out there in my video called Brokerage Platform Review. So for all my American viewers out there, I think TD Ameritrade is the best for you. For our international viewers, Saxo Bank is better for accounts between $10,000 and $100,000. Please use my link in the description if you don't mind helping me out. I'm trying to be friends with Saxo. I think Interactive Brokers is better for accounts over $100,000. So decide on a platform and go through the sign up process. It actually takes quite a bit of time to get all the documents together and get the account working. And then when you're ready, go ahead and fund the account. Now, all these platforms are a little different, so get the customer service person to help you understand exactly how to put money into your trading account. Now, of course, you can just change your investment plan whenever you like. It is your money at the end of the day. But sticking to one and not changing it is going to be the better long-term strategy because your investment plan just needs time to work. So first, we're going to look at the passive investment strategies, and then we're going to look at the active investment strategies. So let's start with the passive ones. Now, plan A is going to be following what's called the acquirer's multiple strategy. Check out my video review of this strategy, and I also recommend reading the book as well. If you think it is the right strategy for you and you can be disciplined and stick to it, then this is it's almost a passive strategy. Now, plan B, this is going to be what's called the magic formula strategy, and it's similar to the acquirer's multiple. And again, watch my video and read the book as well. Maybe this one is more suitable for you, and it's another almost passive strategy. Plan C, and the easiest by far, is investing in the index fund strategy. This is by far the easiest of the strategies. You really don't have to even understand all the terms we learned back in step 6. If you're happy to just go along with the market and believe that capitalism is alive and well, then just do this. Now let me explain exactly what you need to do. So what you'll need to do is invest in the 2 biggest and lowest fee index funds in the world. Now they are based in America, so you will be subject to 30% withholding tax on your dividends. In your investment platform, type VOO or IVV as the ticker. These are the index funds you want. If you don't want that 30% withholding tax taken from you each quarter on the dividends, well, there is the Ireland ETF option for some people. Please check with your tax specialist as everyone's situation is a little different. Now, the codes for the Irish-based S&P 500 index funds are VUSA, that's for the Vanguard version, and CSPX, and that's for the BlackRock version. Both have low fees as well. Okay, now this is really important for all you passive investors out there. Please don't get a stock market advisor or a fund manager or a stockbroker or anything like that. They're going to take so much money from you in fees every year that, look, you can just do this yourself by investing in the index funds. You're probably going to get better returns anyway. All right, for all of us active investors out there, the first plan is to just copy the legendary investors and just don't think too much. Now, I personally even take some of their ideas. And it will take a little work to read that 13F filings each quarter. But if you think these guys have done the hard research for you, just copy them. And after a few years, you should have a portfolio that does look very similar to your favorite investor. But remember, you're never going to have the portfolio exactly the same. So remember when we looked at the 13F earlier from Berkshire Hathaway, where they have a lot of Apple shares? They bought that at a price far less than what it is today. So going forward, we might never see that price again. So we may never invest in Apple. But over a long period of time, our portfolios are going to look very similar. And plan B here for all you active investors out there is to analyze the companies yourself and take responsibility. And this is what I do. And I explain a lot of it here in this channel. I love doing it, and I'm happy to spend my free time reading reports and learning how to get better and better. And this is my strategy. The first thing I try to do is really understand the industry and the company's place in that industry. Then I try to understand and be happy with the financial situation of the company. Please watch any of my individual company analysis videos to see what I'm talking about here. So the next thing I do is I make a thesis for the investment. Here's an example of putting together a thesis, and this is going to be an example from my oil tanker thesis. So when the world returns back to normal demand for oil, there will be lower than normal supply of oil tankers on the water to move this oil around the world. Therefore, the rates that the oil tanker companies can charge will be higher. Therefore, they're going to make more profit. And the orders for new oil tankers to hit the water are at all-time lows. So I'm very confident that the thesis is going to play out over the next 2 to 3 years. Once I have invested, what I do is I just monitor the thesis and just see how it is unfolding. Oh, but when I am buying, I'm always making sure I get a really big discount to intrinsic value. This is critical to reducing risk and improving my overall results. Regarding selling, well, I'm only going to sell when the thesis has changed or it's finished playing out. But hopefully the intrinsic value just keeps growing with the company and that I never have to sell. So we've made it. You're finally ready to put your money into your first investment and you've got your brokerage account funded now, so it's going to be pretty easy. Now, of course, each platform is a little different, and I've done tutorial videos on both Saxo Bank and Interactive Brokers in the past. So if you're going to have one of those brokerage platforms, please go back and watch my tutorial videos. But I did say that I would do a demonstration of an order, so let me show you how to do that right now. So I'm in the Saxo Trader Go platform right now, and I'm going to show you how to place an order. So what I've done here first is in my watch list, I've got all the different companies that I'm watching, and we're going to look today at Prudential Financial, and I've just clicked on that now. And over here on the right-hand side, it gives me some information about today's action with Prudential Financial. I want to press the trade button just here. And what this is called a trade ticket that's come up. Now, the type of order I'm going to place today is called a limit. You can place a market order. There's actually lots of different other types, but look, I like limit orders because it's going to get me the price that I want. I'm going to buy these shares. Now, the amount of shares I'm going to buy. Now, the share price at the moment is $66. So, well, if I bought 100 shares, it tells me down here that that's going to cost me $6,000, a bit over $6,000. I like to make it a bit bigger orders than that. 7,000 is probably the best for fees for Saxo Trader Go. I'm going to do a little bit higher just because I like to buy in bigger parcels now. So I'm going to do about 250 shares. And the price that I want to buy them at, I actually want to buy them at a lot lower than they are now. I actually want to buy them at $62. So that's the price that I'm wanting to buy them at. Sometime, hopefully in the next few weeks, the price gets down to $62 and I'll pick up these shares. The duration. Now, it's important that you have GTC. That means good till cancelled. So it means we don't have to go in every day and redo this trade ticket. It'll just cancel when this order is filled. Okay, here we go. I'm going to place the order right now. And it wants me to confirm, no problem. Get a little notification over here that an order has been placed. I press OK. Over here in the Orders tab, I click on that to see that I have my Prudential Financial order right here. That's it. I can just sit back and wait. I literally going to log out right now, and that's it. That's how you place an order. Now, just to reiterate, don't get too fancy with stop losses or other types of algorithm buying and selling. Look, just place the limit order at the price you're wanting to buy them at. And I explain this a lot more detail in my Interactive Brokers and my Saxo Trader Go tutorials. So why are you at an advantage over the professionals? Well, it's because they can't invest in some of the companies that you can. See, when you're managing billions of dollars, well, you really have to invest only in big companies. See, imagine the managers of Prudential Financial who have over $1 trillion in managed assets. They can't invest in a tiny $10 million company because even if the price goes up 1,000%, well, that's really not going to make any difference to $1 trillion. So they have to invest in places where they can take out reasonable stakes in companies and get some sort of return on that huge amount of money. Being a small investor is great because we don't have to compete with the big boys, and especially when we're looking at small and micro cap companies. Now, because there's less competition, that means there is more inefficiencies in this small micro cap world. Therefore, there's going to be more opportunity. Even Warren Buffett admitted that if he only had $1 million, that he is really confident that he could get 50% returns per annum. But now that he has hundreds of billions of dollars, well, he can't get anywhere near that. And that's just because there's just far less opportunities in the large market cap space. So being an individual investor with small amounts of money is actually a big advantage. Okay, so here's what we covered in today's video. You need to decide what type of investor are you? Are you going to be passive or active? Make sure you keep it really simple as well. Clone your favorite investors for great ideas. Paper trade if you're feeling uncomfortable and a bit nervous about putting your hard-earned money to work. Get comfortable with down days. That feeling of seeing your money go down is what makes great investors great, and because they're not going to panic and they're just going to hold strong to their thesis. If you are going to be an active investor, make sure you learn the investing terms because you're going to need them. For all of us, we need to get a good, reliable trading account. Then you've got to decide on your investment strategy. Put a plan together. Then place your first order just like I've showed you how to do today. And remember, you have an advantage over all those big hedge fund managers and professionals. I really hope you appreciated this roadmap, and don't forget to hit the like button to show me that this video was helpful for you. And remember to subscribe to my channel so you're not missing any of my future videos, and I will see you next time.